Good morning, ladies and gentlemen. Welcome to the Artemis Alpha Trust PLC results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab just situated on the right-hand corner of your screen. Just simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it is appropriate to do so. Before we begin, we'd like to submit the following poll, and if you could give that your kind attention, I'm sure the company will be most grateful. I'd now like to hand over to Fund Manager Kartik Kumar. Good morning.
Good morning. Hello everyone. Agenda for today is to run through a couple of things. Firstly, a reminder of what the trust is looking to achieve, a recap on performance, current macro views, how the portfolio is positioned. If we have time, I'm going to present a stock example, which is our largest position, before opening to Q&A. So I'm going to run through a presentation in that order. So first off, just a couple of comments on performance. I've looked here over 1 year, but I'll also address the calendar year performances, as that might be how some people look at it. Year to date, the trust is probably today up 9% ahead of the index, but fully recognise that both 21 and 22 were actually pretty poor years, and that followed prior years of pretty strong performance. And there are a couple of reasons for this, but they largely fall into two categories. One being that pandemic winners are largely now being seen as the market as losers. I think there's some reasonable reasons for that, but there's also a degree to which, and I'll talk about this further, in which we think that's unjustified. And the other thing being that the UK domestic index and companies within it, of which we have approximately 45% of our NAV exposed to, have been very weak in the last year and a half. So I'll comment specifically on what the contributors and detractors to performance when I look through the portfolio. Just a kind of reminder of what we're looking to achieve. So our objective is to outperform the FTSE All-Share Index, but there are a couple of characteristics which clearly make our trust quite idiosyncratic and different, and a couple of them are stated here. So firstly, I think this is very important. Our interests are highly aligned with shareholders. So John Dodd, who is my co-manager, is the second largest holder in the trust. You can see from public disclosures that I'm a very significant shareholder relative to my own assets in the vehicle. I've sometimes made the joke that it'd be irresponsible for any investor I know to be more invested in the trust than I am, or rather, I don't know whether that means it's irresponsible for me to have that allocation. This is very much a bottom-up stock driven portfolio, which is contingent on fundamental research, and I hope we'll give you an insight into that. The portfolio is concentrated, so the top 10 stocks account for almost 60% of the portfolio, and as a result, you can see we're highly concentrated in areas which can be quite different to the market. So our tracking error is quite often in the teens. That means with a one standard deviation event, you would expect us to be plus or minus over 15% different from the index. Evidently, our aspiration is to be to the upside, but I've seen in the last year that can also happen to the downside. And if you look at the portfolio today, we're really focused on two areas. One is capital cycles. So my judgment would be that the combination of zero interest rates for a long period of time, as well as having firstly a pandemic and then an inflation shock, has led to very odd supply and demand situations in a number of industries from which we're looking to benefit. But we also have a significant proportion of the portfolio exposed to what I would call durable franchises. This is where returns are more predictable. They're not particularly dependent on a cycle. And that I will explain to you why I think those continue to be attractive even in an era of higher discount rates. Underlying portfolio is liquid. So about 80% of our portfolio could be sold really quite quickly within a week. And that's despite the overall vehicle not being that liquid. And I think the important point, which is particularly relevant today, I would say, is we stand to benefit from the undervaluation in UK assets. And I guess allied to that, I should note that one differentiating feature of the trust is that we have about 25% of our NAV invested in overseas assets, which have been a strong source of return. This is just a recap of the process. So we think alpha comes from three different buckets, or it's how we like to characterize it. One is taking a variant perception on the risk or return in a stock. It's as important that it can be in the risk or the return. And we really think, sort of echo the George Soros quote, that to be a differentiated investor, you have to have a differentiated view on risk or return. Minimizing behavioral biases. So this is trying not to be human. And we try and set up our processes in a way that sort of fights against the psychological bias to buy high and sell low and do the opposite. And then lastly, in terms of money management, this is I think a point that's underemphasized is that what's almost as important is how you put a portfolio together to let you take advantage of opportunities. And if I was being critical, one of the issues we had is, whereas in COVID, our portfolio construction worked very well, over the last 18 months, it didn't work so well. And it's something that we're very conscious of. Just and you'll see this in the stock example we highlight is it's a very valuation driven process. I think you'd call us a value investor, but sometimes it doesn't look like that. But very importantly, the way I like to think about a stock or portfolio stocks is like they are an alternative to a savings account. And in order to do that, I think you need to come up with a view on what they're going to return for you, bearing in mind that return will vary. That inherently the reason why you're being compensated is because stock returns are uncertain. That uncertainty ranges. But we have sort of moved from coming up with intrinsic values to being more specific about it and really going for each stock in the portfolio to say quite explicitly what we think the IRR will be on it, which requires a judgment on your future earnings. That will be variable in certain segments, well, variable everywhere, but more particularly so in cyclical sectors. Coming up with a view on how capital efficient that is and what it means for capital allocation. Evidently, if you get you can be more sure about a dividend than you can be about cash in a company's bank account. And coming up with a view on effectively what multiple you believe the stock should trade at, which is a function of its earnings growth and how efficient that capital is, to come up with a view of what you expect a stock to return. And I think I can say this because it's highly uncertain observation, but on today's metric, our portfolio weighted IRR would be in excess of 20%, which is why I partly think it's a very attractive time to invest. So I'm going to come on to I'm just going to run through some points on macro, which frankly I believe is relevant for any UK equity fund, as this trust is, but particularly given it'll explain how we're positioned before I look at specific points within the portfolio. So the 2 points I want to address is the inflation question, which I think has evolved. This would have been a broad macro equation, but currently Spanish inflation is under 2%, whereas the UK is effectively considered to have an idiosyncratic inflation problem, which I think is unjustified. But also kind of irrespective of your view of macro, because of the pessimism that exists and those uncertainties, you're being paid quite a lot to take on that risk, which doesn't guarantee you a good outcome, but I think it suggests that the odds are in your favor to making good returns. So I'm going to try and explain why I think UK inflation will ease and why I think UK equity risk premium is elevated and therefore prospective returns in stocks is compelling. I'm going to sort of canter through this because I did touch on this at the AGM if you listen to that presentation. But the first observation I'd make is that I think inflation has been distorted as a consequence of a number of shocks. Firstly, during the pandemic, where effectively demand shifted from services to goods, you effectively couldn't consume a lot of services, and there wasn't enough supply to meet that goods demand. So you therefore had, for example, container rates going through the roof, but you also had governments stimulating the economy, not knowing how bad the crisis would be. And in my opinion, the Milton Friedman quote of inflation is always a monetary phenomenon has proven right over the last few years. And that's why I think it's quite important to note when you add in things like energy and how sharply that impacted inflation last year, that there were a number of temporary and exogenous factors that led to inflation being very high, both globally, but also in the UK. There's one very specific factor that is relevant to the UK is about labour market tightness. And I'll touch on that. I view that as a sort of key risk to this view, but I think that's actually improved recently. So I guess the first observation I'm making is there were abnormal circumstances that led to abnormally high inflation. And this is the chart which I think is probably most important, is if you look, the only economists who got the inflation spike right were the monetarists. It wasn't the Bank of England, it wasn't the conventional Keynesian. And there, they would also point out right now that the key point is an extreme monetarist actually doesn't think interest rates impact inflation. It's purely money supply. And if you look at it through that lens, the combination of not having QE and raising interest rates has led to a very sharp fall in money supply, both in the UK, US, and Europe. And I think that's really probably quite important. It's the highest factor that I would put a weighting on. But if you look at some of these exogenous factors, here you can see that effectively container pricing had its own bubble during the pandemic. You can see the baseload electricity prices have fallen roughly 80% from the peak last year. And one needs to remember that electricity in the UK and Europe is set off gas prices. Gas is fundamentally a very abundant commodity. We can talk about energy views later. But I guess one of the biggest problems has been, and which looks specific to the UK, is the labour market. So there has been this odd phenomenon everywhere where labour market participation declined following the pandemic. And in my opinion, the two reasons to be optimistic that this will resolve itself is, firstly, that's what recessions do, is when demand falls, labour supply, the demand for labour falls too, and therefore supply pressure eases. But you can see things like UK migration hit 600,000 in 2022. Many of the sort of Brexit pessimists would really have not predicted that. And I also think that negative real wage inflation is a significant incentive to come back into the workforce. This equation also explains why you have such an odd situation in markets where employment, which is actually the key driver of earnings across many sectors, has been pretty robust, but consumer confidence is so weak as a result of inflation and everything you've been reading. And the last point I'd note is if you look at producer price inflation, it has already fallen very sharply. CPI hasn't followed yet, and evidently that's what has been leading bond markets. But I think the key is wages and service sector inflation a forward or a backward-looking metric, i.e., is it reflecting the inflation you already have or the inflation you will have? And it's really that why I take a much more sanguine view on inflation. And I guess today's CPI number, but it could have gone the other way, has suggested that view might be unfolding. Just on UK stocks, I mean, sort of the UK is being referred to as a submerging market. If you looked at the FT yesterday, there were three hideous headlines about there's a crisis in UK universities, why you should never invest in gilts, and UK profit warnings reach all-time high, or since 2020. So, I mean, it sort of seems quite odd, but I just want to recap why I actually think the UK is a pretty decent place to invest. I think some of these points are obvious, but I mean, stating one in particular, I mean, English is a universal language. The UK has monetary independence. The pound is, the UK can set its own monetary policy. The pro-business climate is probably the one on this list that looks least correct today. And it's kind of interesting to see that there are many businesses who would actually prefer a Labour government. I'll give you an example of Berkeley Group in house building, where you would never have thought that to be the case. But I guess probably, in my view, the clearest negative that came out of Brexit is the division it's led to and the polarisation of views in UK politics, where business has suffered as a result of, I think, poor decision making. But the key point, I really think, for you're not buying the UK economy, you're buying stocks, you're buying share prices, and there it's the elevated risk premium. So this is something which I think was, and I still sort of think fundamentally it is misunderstood in some areas, which is that higher inflation, all else being equal, is good for equity values. Now, it isn't good if it causes a recession. It isn't good if it causes a cyclical to temporarily fall in value. But if you think about it, if you're valuing Coca-Cola, evidently over the long term, inflation is good for it. On the negative is if you have a higher risk-free alternative to invest your money in, then evidently equity values fall. But just to point out, if you sat here a year ago and you thought UK if you were to say that rates will actually stay higher, let's call it 4-5%, you wouldn't have predicted that Microsoft would reach an all-time high. You wouldn't have predicted that L'Oreal would be at all-time highs. But it's really, in my opinion, because those are clear inflation-linked stocks, which also have demonstrated strong earnings growth. And that's why I think it's quite important to remember that in equities, you're buying a nominal piece of paper that you can own the profits for into perpetuity. And for that reason, I sort of think that some of the, when particularly in the last year, when nominal interest rates have been compared to earnings yields in equities, which should be inflation linked, it's drawing the wrong comparison. So looking here, this is how I'm sort of building up to the point that I think equity risk premium in the UK is very elevated. If you look historically, I actually think the important number today is not that UK 10-year bonds are 4.2%. It's that UK 10-year real bonds yield 1%. So the most you could make in real terms from investing risk-free in the UK is 1%. FTSE All-Share yields about 10, bounces around a bit between 9 and 11. Let's call it 10. But that would imply that equity risk premium in the UK market is about 9%. And if you look historically, even were elevated, so real rates were much higher back in the 90s, equity risk premium was much lower than this. Now, there are lots of factors which are not that relevant today in terms of what about the fact that a third of the UK market's earnings come from commodities, energy and banking, where you might question whether earnings can grow in real terms. But I'm just pointing out that historically, equity risk premium has been about 5% in the UK. That's skewed by the 90s, which ironically is when rates were lower. And you can see today that equity risk premium is materially higher than that. And the important conclusion I think that comes from this is it's not equities that were mispriced in the last few years. It was actually the bond market. So coming to the portfolio, and I'll kind of explain how the portfolio I think is benefiting from, or stands to benefit from a reversion of this mispricing. And it really comes down to this point of capital cycle businesses are yielding well over 10% in earnings terms. And I think the earnings prospects there are robust, although those carry risks. And then on the other side, you can buy durable franchises where your prospective returns are really quite robust in terms of the inflation linking. But they yield, the equity risk premium over bonds is still quite attractive. Before I come on to that, I just wanted to talk about performance in a bit more detail over the last. So this is just looking at the last year. So if you look on the last year, these are the top contributors to performance and how much the share price has changed by. So running left to right, Dignity is a bit of an odd one because that had a takeover bid in January from very depressed levels, and perhaps in the Q&A I can talk about it, but we've sold about 40% of our holding into the offer, and we've actually retained a very significant holding because we think the stock continues to be significantly undervalued in the private vehicle through the investment trust that holds it. But you can see a number of the airlines have been very strong coming off last year's lows. Still think that earnings there are benefiting from a supply-demand imbalance and that the stocks represent good value. But you see other things here. So, for example, we bought holdings in Meta and Google in Q4. Those have been very strong contributors. And a range of other holdings, which I would say largely fall in the sort of long duration bucket, have been strong contributors. On the detractor side, and I guess this is why I feel quite optimistic about portfolio potential, is a number of these I don't really see any loss of value, or in my opinion, the falling share price represents prospective returns rising, all else being equal. So if you take Hornby as an example, that's a small stock, which, I mean, the market cap today is 35 million. It's going through a direct-to-consumer transition, which I think will significantly improve its profitability. It's working on a strategic transaction at the moment, which I think would be very material to value. And so there, I really view that as a sort of fluctuation in the share price and not a sort of impairment of value. Alibaba we sold our Chinese tech holdings. We got those wrong. We misunderstood the regulatory risk there, and we invested them in the US tech. You don't need to make it back the way you lost it. So that's sort of worked out well from us, having been a pretty material mistake. And you can see on the right is the other detractors are largely sort of a mixture of UK domestic cyclicals that have caused underperformance more recently. Coming on to activity, we've been quite active in the last year, and a lot of it has been in new holdings, and the concentration in the portfolio has fallen as a result. And that's partly because I think we found that we've been able to diversify the sources of return that we find without giving up much of the upside we could see. And it also reflects effectively things such as reducing our position in Dignity, which was a significant chunk of capital. So I think I'm just going to really focus on some of our new holdings and sort of canter through these. But we started a holding in BP and Shell in March, and we've built that up through June. So most buying done in May and June. Reason being that my personal view is that the best hedge towards geopolitical risk in a long-only construct remains energy. These holdings have 12% free cash flow yields, and there are lots of fundamental reasons for why I believe that energy markets are undersupplied and why we've got slightly lucky with warm weather. I wrote about this in our last quarterly fact sheet, if you'd like more detail there. Google and Facebook, we bought those in Q4, and just as an indicator, I mean, Meta, when we bought that in Q4 at $105, we were predicting prospective returns of over 30%. It's now $310. We've reduced the holdings because our prospective returns have fallen towards 10. There might be upside in earnings from effectively the generative AI on the business, but it's just less attractive than it was then. And I think we've made over 3%, 4% contribution to NAV from Meta in the last 5 years, because we owned it from 18 to 20, bought it back in the pandemic, sold out in 21, and we repurchased it again in 22. So we have made good money in some of these overseas holdings. NatWest, we sold our holdings in Barclays about a year and a half, 2 years ago, and we're really rebuilding our UK banking exposure because we think that the significant rise in rates has permanently improved their earnings power. Zero interest rates are really quite damaging for how you can earn a spread on the liability side for a bank. Haleon is a company that was demerged from GlaxoSmithKline in July. It fell 25% in August on concerns of Zantac. We thought that was misplaced, and so we doubled our holding then, and the stocks recovered quite nicely from that. Hargreaves Lansdown is a new holding which we started in January. The stock's fallen really quite significantly from £30 a share to our in price is £8.20. It has 42% of the D2C market, yields over 5%. It's got a net cash balance sheet. We think that the structural concerns over pricing are misplaced, and that it would be either it will improve over time in terms of its growth potential and reinvest in pricing, or that it would be a very good takeout candidate. So our prospective IRRs that are in the 20s, and we thought really quite compelling. On the right-hand side, sort of Vancy and Universal Music Group are examples of long-duration stocks where we were quite opportunistic about it. Universal sold off in May on generative AI concerns. For a lot of reasons, I think AI is not going to materially impact the way music is distributed, which is what is leading to an increase in Universal Music Group's revenue, which is effectively Spotify and streaming services are underpenetrated. Barclay Group, we added to the House Builder stable in August. And LST Group is one that's quite widely held here at Artemis, and which we've been warm on for some time. We've bought and sold it a couple of times, but we took part in the placing there again to build up some of our longer duration holdings. So if I look at how the portfolio is structured today, if you see on the sort of bottom side is we have about 40% invested in what I'd call UK capital cycle plays, and you know that ranges from house builders, which I think are very topical today, but effectively really think these are mispriced. They've got net cash balance sheets. They trade at significant discounts to book values, i.e. you can buy land and get the cash generative franchise for free. And our views of the macro actually impacts the value much less than people think, because as long as you have a shortage of housing in the UK, as you see today, when you can't afford to buy a house, people still need to rent them because the houses need to be occupied. And so these are far more volatile than the business values would suggest. And we've been adding, so we've actually increased this holding in the last month as UK rate expectations rose. Airlines, I've touched on a number of fact sheets, but effectively Boeing and Airbus couldn't produce 2,000 planes during the pandemic. it means that you just can't improve capacity today. Demand is as strong as it's ever been, particularly in leisure, not so much in business. And we're focused on the two low-cost carriers there, where it'll be interesting to see EasyJet report tomorrow. But we think profit expectations are too low and that the businesses have very durable advantages. UK retail, I'm going to talk about Frasers after this, so I'll save that. But if I were to characterize it in all of these segments here, energy is slightly different because that's a sort of portfolio construction play. I'd say, on our judgment, prospective returns could be in excess of 20%, and materially more than that in some cases, and so hence we think it's very attractive to be in them. In the middle segment, you see a sort of different range of holdings. Nintendo is a stock we've held in the portfolio since 2016. Super Mario Brothers movies is now the second most popular animation of all time. The stock is valued on 13, 14 times earnings, and we think it's navigating a paradigm shift in consoles, which will structurally improve its earnings as it came from a base of having low digitalization. And I guess coming to the top is we still do have a couple of sort of more idiosyncratic plays. We're still invested in Dignity, which I could talk on, but I think has the potential to add really outsized returns to the portfolio. I've said that for some time. It hasn't quite been right so far, but I think it's really quite interesting from the point of view of its crematoria business, substantially accounting for the market cap today. I'm sorry, I've lost my slides, so I'm just going to try and pull them up again. Thank you. And this is a snapshot of the portfolio as it's positioned today. And I thought I would sort of just try and round off quickly on a stock example, because as you can see, Frasers is the largest stock in the portfolio at 12%. Why do I want to tell you about Frasers? Is because I suspect a lot of people will look at a trust and say, I read a lot about Mike Ashley, how can you have 12% in this? Or you might say, how has your investment process led you to having a 12% position in one company? So I really just wanted to give you an insight into the way we think about the stock, our journey with it, and really so to give you a microcosm of a lot of other holdings that would sort of have gone on the same journey. So I'll do this in about 10 minutes at the most, and then stop for questions. If I look at Frasers Group, just to kind of characterize what it is sports retail is a duopoly between JD Sports, which covers the sort of athleisure portion, and Frasers Group, which covers actual sporting goods. So if anyone's a parent and tried to buy football boots in the UK, you'll know that there are not very many places to go. Amazon doesn't do it properly. Sports Direct is effectively a de facto monopoly on sporting goods, and that's come from effectively outcompeting everyone. Luxury retail is something where I think elements of the market don't even know that Frasers have this business, but there are two things here. Luxury has been a structurally expanding space. You can see that LVMH is the most valuable company in Europe. Bernard Arnault is, depending on the day, the richest man in the world. It's been structurally growing because of social media, but the way it's served, particularly in the UK, has changed because department stores collapsed, and so it's best done through omni-channel. Department stores left, particularly regionally, a hole for distribution, and Frasers have been filling that hole through its flannels brand. It's got a very strong own label offering, so about 30-40% of the sales in sportswear are its own label. So when you're watching Wimbledon, Slazenger, fully owned by Frasers. Everlast has got about an 80% share in mixed martial arts, fully owned by Frasers. I actually, it's not part of our case, but we think there's a really good brands to own and have. It's really important because it's a differentiating factor for why customers go to the store. And usually what they do is they can set the pricing on it to be materially below Adidas and Nike, so there's constant footfall. Low-cost operations. So if you benchmark it, and I'll show you this, they've got the lowest cost to serve in the UK. Excellent capital allocation is something that I know will sound very controversial, or maybe not, but the capital allocation, I think, is adding value, which the market is really neglecting, and compounds over time. and the management team. So Mike Ashley currently owns 70% of the company. The CEO doesn't take a salary from the business. Mike Ashley never took a salary from the business. The way they make money is fully aligned with shareholders. And I'll show you why I currently judge prospective returns in the company to be in excess of 30%, which on a 3-year basis, which I think is very attractive. So just to point out the history of Frasers Group is we started buying Frasers, I started buying Frasers in the trust in 2016. Its profits fell very sharply because it was unhedged on sterling when it devalued after Brexit. The stock fell to a trough of £1.80 at times in 2018. Our average in price is well below £3 a share. We invested about 5% of NAV in it, and we've held on. So we haven't materially changed our holding, bar from resizing as a result of doing buybacks in the trust since 2018. And it's a winner that we've constantly reappraised our upside and the risk in, and we've always found that it warranted not doing anything from our initial investment decision. And just to point out, I mean, I think I've seen the stock halve. I think the stock's halved in our portfolio 3 times, maybe 6 times down 30, and our IRR on it so far has been in excess of 25%. And this is, we've noticed a lot of change over this period of being invested in the company. And the key one has been, firstly, what happened in sportswear, which is, if you look on the left, that's the Birmingham Old. On the right, it's the Birmingham New. The company really evolved its business to serve brands. And this was recognizing that Nike had a new option, which is they could go direct to consumer, and the pile 'em high, sell it cheap wasn't going to work. And more than that is brands are increasingly important for consumers. So they've really changed the way they serve the customers. And in part, what's also changed is the brand relationships with the business have evolved considerably, which I think has opened up all sorts of new opportunities. The easiest way to see it is we do this, but if you have a look at what the highest ASP Nike trainer is in running or footwear or soccer in the business, the ASP has gone from £60 to well over 150, 200, and you can imagine the gross profit per unit on that is substantial. Just to point it out, we've been doing price studies for quite a long period of time. Sports Direct is very rarely beaten on price. They change prices constantly, and therefore I think it makes the returns even more impressive, because it's not like the case in many other retailers where you need to be very conscious of the risk of over-earning or the risk that Amazon would undercut you. Flannels has just grown incredibly, and it's been an enormous success. It was bought for virtually nothing, but the revenues in this business are growing at more than 35% per annum. It's annualizing over £1 billion. If you're just based in London, you won't really see it. It's largely in the regions. On the left is a department store that they've started in Liverpool, which is over 100,000 square feet. And just to give you an indication of why this isn't actually that unusual is the Selfridges business ex-London is highly profitable. And so if you think about it, it's a great proposition for the brands. It's a great proposition for the consumers, having price competitive experiential retail. And you can see from the luxury brands how much they're investing to grow their markets. The logistics point is something which I think is not known. Frasers have the largest installation of AutoStore, which is a listed company in the Nordics. Their warehouse has been retrofitted and automated. They spent over £200 million there. If you think in a tough retail environment, there's just not many other people who can do it. Shirebrook, which I visited 3 times in the last 6 years, is 42 football pitches large, and actually they're building a new centre in Coventry, which will be even larger. Why is this important? Is because within very consistent cash generation that comes from the sportswear business is, I think, one of the most impressive allocations of capital that I've seen in the market in terms of what they do with it. So if you look here, and I'll update this, the company reports next Thursdays. Since we've been invested in 2015 till the last year end, the company's generated about 1.4 billion in free cash flow. And in that period, it's spent about 500 million in share buybacks. So the share count is down 20%. And if you look to year to date, it's down about 25%. And I don't think the market understands how much of an impact that has, both on earnings per share, but actually also on technicals. So if you bear in mind, Mike actually hasn't spent a penny, and his ownership's gone from 50% to 70%. It's the same analogy with Apple and Warren Buffett. We haven't spent any money since 2018 on this, and our holdings gone up, and our share of the earnings have gone up in a business that's growing its earnings. But on top of that, the important thing that the company can do is it can buy a number of businesses. So, what it tends to do is it tends to wait for distress, and then it tends to buy businesses where it pays a price that it's hard for it to be a bad deal. Jack Wills paid £10 million for it. Was the stock value. It's now making over £10 million. Flannels was bought from bankruptcy. You've seen a lot of activity, Gives and Hawks, more recently. Studio Retail is a very big player on financing. And so it has the infrastructure and the distribution that means, and the entrepreneurial approach to capital allocation that means that it can take a pound and, in my opinion, invest it at a higher return than effectively I would make if you gave it back to me, although I hope that's not entirely true. And here you can see the cash flow from operations has grown really quite consistently. So this is totally illustrative, but just to point out to you how I don't think you need to do much daydreaming to come up with quite a compelling valuation for the business is revenue growth is pretty well bolted on because it's driven by Flannels, and these are taking consensus numbers, so I'm not even needing to tell you what I think. Operating profits, therefore, with very modest operational gearing, grow by a little bit more than that. The share repurchases, 3% a year, that's £90 million. They've been running much further ahead of that, would get you to earnings growth of 12% a year. So even if you disagreed with me and said, Kartik, I don't think the stock's worth 12 times earnings, which is below the multiple that Next trades at, and Next doesn't have brands, Next has lower earnings growth, or you maybe need a corporate governance discount, which I think it is corporate governance premium, you would get to an internal rate of return of about 30%. That would get you to about £14 a share, bearing in mind that management's incentives don't actually kick in until £15 a share. And just bear in mind, in all of this equation, I think there's no upside for recent M&A. Their financing solution that they've put forward called Fraser's Pay, and also Europe, where Nike have indicated a potential to help them expand there, where there's no consolidated sporting goods retailer like there is in America. It's Dick's Sporting Goods, like there is here, Fraser's or Sports Direct. And so I think that's really quite an important point. I'm going to. I think I'll draw close to the presentation there. I'll run through some Q&A.
That's great, Kartik. Thank you so much for updating investors this morning, ladies and gentlemen. Please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review the questions submitted today, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. Kartik, we have received a number of questions from investors this morning, so thank you to everybody for your engagement. Kartik, may I invite you just to open up the Q&A tab on the right-hand corner of the screen, and if I could just ask you to read out the questions and then give a response where it's appropriate to do so, and I'll pick up from you at the end.
Yes, sure. How about the first? I'll start with, do you have exposure to private companies in the portfolio? How do the valuations compare to listed investments? So yes, unlisted today are about 9% of net asset value. As an indicator, in 2018, when I first proposed a turnaround strategy, that was 30%. The two largest ones account for 8 out of that 9%, which is Reaction Engines. You can look this company up. It's an aerospace company that has BAE, Rolls-Royce, and the Sovereign Wealth Fund as its largest shareholders. If it were our valuation, or the last funding round, it just raised £50 million from the Sovereign Wealth Fund. Sorry, 40 million is about 300 million. So we've got a very small proportion of it. And that's really our key unlisted company. How does that valuation compare to listed investments? It would be hard to draw a clear comparison because it's pretty idiosyncratic. Our second largest investment is in Singers, which is a brokerage company that you might know of. We value that company at 1.4 times cash. Just as an indication, Numis, which was the peer that we used to track, would usually trade at about 2 to 2.5 times book, and its book is slightly different, and it was just acquired by Deutsche Bank at 2 times book. So that valuation, I think, has at times looked extremely conservative. But right now, investment banking revenues are down, so I think it looks less so. But we've always valued it on a through the cycle asset value basis to try and not effectively come into the problem of putting a high multiple on peak earnings. The rest of the unlisted exposure is small, and it's largely holdings that are in runoff where we've written off a very large proportion of it. You implied at the start that you were aligned with investors. What percentage of the company does the current management own, and does this have any impact on free float liquidity and therefore the NAV? So current and existing partners of Artemis own approximately 25% of NAV. That changes, that fluctuates a bit. I've seen 20 and 30. It fluctuates a bit depending on the latest number and who's retired. So it is a substantial proportion, and John Dodd has a high single digits share of the company. Does that have an impact on free float liquidity? Yes, it will do, because those shares tend to not be traded that significantly. Does it have an impact on NAV? No, there'd be no reason for it to have an impact on the NAV, but yes, it does impact liquidity. I'll get to the next one. I know your investment mandate is international, yet your focus is the UK. What is your view on the attractiveness of the UK versus other regions? Also, with the number of IPOs, etc., going outside the UK, do you see your geographic allocation changing? So the first point, the focus of the investment mandate is the UK. It's just that we have, unlike some others, scope to invest overseas. And what we always say is that we look to invest overseas when we can find a business that would be additive to the portfolio and fits our process. So we wouldn't go and invest in Philip Morris in the US if we could invest in BATS, or we wouldn't go and buy Exxon if we could buy Shell. What is your view on the attractiveness of the UK versus other regions? I would point out, so I manage a European portfolio as well. I've always managed effectively developed markets equities. And I just point out that using exactly the same approach as I do in the UK, the IRR or the prospective returns look materially higher than they do overseas. Now, the counter argument to that is the earnings in the UK over the last 5 years have been weak, and therefore I think you have a higher risk premium. Some of that is understandable given the history, but I don't think it's my judgment would be that it is stretched elastic, in the sense that some of these things need to correct. It's not, you wouldn't expect them to be there for structural factors. Number of IPOs going outside the UK. So I'm not very bothered about IPOs. I tend not to invest in them very much. Someone has to. If you think about how an IPO works, is you've got asymmetric information, and effectively someone is selling you something and you're queuing up to buy it with a number of other people. If you look at when we like to buy things, is effectively the great thing about liquid secondary markets is I can look at Google, but I can wait for the price to fall to $95. I don't have to wait for someone to want to sell it to me. So I don't think that'll change our geographic allocation. Our geographic allocation will be a function of the portfolio construction and the opportunity set. So you might see it changing modestly, but I think the way we think about it is we quite like the diversification benefit that comes from having a proportion in these franchises, which I don't think you can invest in the UK. One example I'd give you there is, I think infrastructure is a really nice asset class for public investors. But if you look in the UK, apart from National Grid, there are very few infrastructure investments, whereas there are a number in Europe that you can make. What investment restrictions are there in the fund? Are you limited by the size of company or sector? So let me answer that one first. The fund is pretty unconstrained in terms of its investment restrictions. Many of them that are put in are imposed by the manager. So, for example, we say that we wouldn't go above 30% in overseas. That is largely so because we want you to understand that we are in the UK all company sectors for a reason. We're not constrained by the size of a company or sectors. So if you looked historically, this trust used to have about 2/3 or more of its capital in smaller companies. Today, that's probably 12%. Which sector stands above others in terms of growth potential, in your opinion? I'm not entirely sure whether you mean growth potential of capital or growth potential in terms of earnings growth, because I think the answer would be quite different to the two questions. I guess if I was talking about the growth potential of earnings, the long duration businesses and over the medium term, then something like Universal Music Group could compound its earnings in excess of 10% for 7 years. It's unlikely that cyclically adjusted, that cyclical holdings could do that. But if you ask me where do I think the most capital appreciation would come from, then I think some of these out of favor UK sectors where you have low valuations and potentials for earnings to rise for the structural supply and demand imbalances. Take airlines as an example. Then I think the capital appreciation could be really quite rapid and significant.
That's great. Kartik, thank you very much indeed. I think you've taken all the questions from investors. So thank you everyone for your questions this morning for Kartik. Kartik, I know investors' feedback will be important to you, and I'll shortly redirect those on the call to give you their thoughts and expectations. But I wonder, before doing so, if I may, Kartik, just ask you for a few closing comments just to wrap up with, and then I'll send investors to give you their feedback.
I think I've kind of covered it. I think the UK macro is likely to get better, but it doesn't need to because risk premium is very elevated. I think we have a reasonably idiosyncratic portfolio where we stand to benefit from the UK mispricing, but also where there are a number of individual companies which could make a very material difference to our portfolio. And we're constantly working hard to try and improve that risk-adjusted return equation. But I'd say from where I sit today, and you can see it from our holding in the company, the last 5 years haven't been easy, but I would like to think that the probability is that the prospects from here are quite positive.
That's great, Kartik. Thank you once again for updating investors today. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of Kartik and the team from Artemis Alpha Trust PLC, I'd like to thank you for attending today's presentation. Good morning to you all.